Okay, we are going to get going on this evening's webinar on disability insurance and life insurance for physicians. My name is Jay Weinberg. Before we get into the content, I want everybody to take a minute and take their cell phone and scan this QR here, code right on the bottom left side of your screen. This is going to add me to the contacts of your cell phone. And then whenever the time comes that you want to discuss disability insurance or life insurance, you're going to have me already programmed into your phone and you can easily get a hold of me. Furthermore, if anybody wants to block out time to discuss their specific situation, feel free to go to my online questionnaire at www.pgy1.com. This will provide me with a global understanding of your situation, and then we can block out some time to discuss your situation confidentially. My name is Jay Weinberg, and I am an independent financial planner. I've been in this line of work for 20 years, and my practice is exclusively with physicians. In a given year, I lecture to somewhere around 100 or so residency and fellowship programs, as well as several medical schools as well. And when I lecture to these specific programs, I typically get into student loan strategies, disability insurance, home ownership and physician mortgage options, tax filing considerations, life insurance, and Roth IRAs. But my two main specialties are going to be disability insurance and life insurance, and that's what this evening's webinar is going to be about. The first thing we'll get into is disability insurance. And when you are looking for a disability insurance policy, the first thing that you want to be extremely cognizant of is what they call own occupation. Own occupation is the litmus test that an insurance company uses to say, if God forbid something were to happen to you, would we have to pay out on this policy or not? Now, if I were to show you 5 different policies from 5 different companies, they're all going to have different wording for this thing called own occupation. Own occupation is not a one-size-fits-all. It's not like a gallon of gasoline where it really doesn't matter what station you get it from. If I show you 5 different policies from 5 different companies, they are all going to have different wording for own occupation. And there are very, very few policies that are going to have the own occupation version that meets whatever your goals and objectives are. Now, the highest level of own occupation is what they call medical specialty specific own occupation. And I'll give you an example of that. We have a tremendous amount of orthopedic surgeons on this webinar tonight. So let's just say you are an orthopedic surgeon and something happens to your back or your neck or your arm, whatever it may be, and you can no longer do your skill set. You can no longer do your surgeries. That in and of itself will trip the litmus test. And then even if you can still stay in medicine doing something else, or if you totally leave medicine, but if you cannot perform your surgeries and you are an orthopedic surgeon, you would be able to collect in full on your policy and earn a full paycheck doing whatever else you do, whether it be inside of medicine or outside of medicine. And there's even one company that accounts for surgical procedures and hands-on patient care. So that's the highest level. That's medical specialty specific, true own occupation. Now, another type of own occupation that I see way too much is what they call modified own occupation. And let me give you an example of modified own occupation. So they say, if you can't do your job, you'll be able to receive full benefits on your policy as long as you are not working in another job. And I'm going to say that again. As long as you can't do your job, you'll receive full benefits as long as you are not working in another job. So if you do something else, it's going to drastically impact your policy. You may not be able to collect in full, or you may not be able to collect at all. These policies are out there, and there are several of them out there. In a given week, I review a tremendous amount of existing policies that people have, and I can't tell you how many policies where people think they're okay with the wording in the policy come to find out that they have modified own occupation wording in that policy. I have yet to meet a physician, especially a procedure-based physician, that is okay with modified own occupation. However, these policies are out there, they're prevalent, and it's really not what you want to have in your specific policy that's protecting your income over the next 20 or 30 or 40 years. The lowest level, which actually is not even own occupation, it's what they call any gainful occupation. Any gainful occupation is typically what I see in group disability insurance policies. And what it says is that if you can perform the duties of any gainful occupation, you would not be eligible to collect on your policy. Now, let me say that again. If you can perform the duties of any gainful occupation, you would not be eligible to collect on this policy. And the reason we see this wording in a lot of group disability insurance policies is because when you go to work somewhere and there's 1,000 other people working there, they're giving this group disability insurance policy to everybody. They're giving it to the good, they're giving it to the bad, and they're giving it to the unhealthy. And whenever they're giving you a policy and when they don't know who they're aligning themselves with, the way that they curtail their risk is by making it virtually impossible to collect on these policies. So I'm not saying every last group disability insurance policy has this any gainful occupation wording in it, but I am telling you that a vast majority of those group disability insurance policies that are out there do contain this wording in them. So you never want to rely on a group disability insurance policy. It's so important to have an individual policy that would be your primary source for coverage. And then if they give you a group disability insurance policy through your employer, have that layer behind your individual disability insurance policy. And while we're talking about group disability insurance, let's talk about some of the differences between group policies and individual policies. Number one, taxation. Typically, group policies are going to be taxable if you need to collect on them. So you may think that you have a policy that covers you for, say, $5,000 or $10,000 a month. Come to find out that it's $5,000 or $10,000 that would then be subject to tax. Whereas individual policies, you're going to pay for them with after-tax dollars. And then if you need to collect on that policy, that's going to be a tax-free benefit. Portability. Group policies, they are typically going to stay behind when you change jobs or employers. Whereas individual policies, you're going to purchase that policy, you're going to put that in your pocket, and you're going to bring that with you from job A to job B to job C. That's so important because many of you are going to change jobs several times throughout your career. The last thing you want to do is have your policy stay behind at the previous employers. So it's so important to have an individual policy that's going to go with you wherever you go and cover you for whatever you're doing. Contract language. As we stated on the previous page, the wording in group policies is typically scaled back because they're given that policy to everybody and they are not asking any medical questions. And the way they curtail their risk is by scaling back the wording and internal features within the policy. Whereas individual policies, these insurance companies, they know who they're aligning themselves with. And in turn, the wording within an individual policy is going to be much more robust than it would be in these group policies. Coverage amounts and caps. I can't tell you how many people think that when they're an attending physician, they're going to get a disability insurance policy that covers their entire income. Well, I hate to be the bearer of bad news, but that's not the case. When they give you a group policy, they're going to say that they cover you for 60% of your income. And you're thinking, great, I'll get 60% of my income. But then you read the next line and it's going to say 60% of your income with a cap of 5,000 a month, or 60% of your income with a cap of $10,000 a month. So when you're an attending physician making $300,000, $400,000, $500,000, $5,000 per month taxable, or $10,000 per month taxable, you're not even going to be able to pay your bills, because if you're getting $5,000 taxable, that's really $3,500, maybe $4,000. When you're used to making $300,000 or $400,000 or $500,000 a year, or even if you get $10,000 and that's taxable, you'll be at somewhere around $7,000 in disability insurance. That is a mere fraction of your income. So it's so important, once again, to have an individual disability insurance policy that is your primary source for coverage. And then if they give you a group policy, have that layer behind your individual policy. And these policies, they don't cost a lot of money. If you're a resident or a fellow, oftentimes you can get your foot in the door for $80 a month, $100 a month, maybe a little bit more, but you're not going to go broke buying these policies. And right now, you know what your health is. And nobody can tell me what their health is going to be in the next 3, 5, or 10 years. So when you lock in an individual policy, assuming you're in favorable health, you're going to get a small policy now, but you're also going to have the ability to increase that coverage at a later date without having to answer any medical questions, which we'll get more into that in a few minutes. There's different types of disability insurance. There's short-term policies and there's long-term policies. Typically, the short-term policies kick in when you're out of work for a week or two. That's when they kick in, and they'll pay out for sometimes 3 to 6 months of benefits. Now, these short-term policies, sometimes they're going to be given to you by your employer. Sometimes they are on a voluntary basis from your employer and you would have to pay for them. And sometimes they're not even an option. So that's short-term coverage. And then there's long-term coverage. Long-term coverage doesn't kick in until you are out of work fully or partially, in some cases, until you're out for 3 months or 6 months. And then these policies can potentially pay out until the age of 65. So these are the long-term policies. And I think it's really important to understand that just because you have a group policy that says it pays out until the age of 65, you need to overcome that hurdle of own occupation, or you need to overcome that hurdle of whatever the definition of total disability is on that policy. So where I'm getting at is, just because a group policy says they're going to pay out till the 65, it doesn't mean it will, because you need to qualify for the claim in order for it to pay out until that age. You may not be able to qualify for any claim on that group policy, or sometimes you may be able to qualify for like 2 years or 5 years, and then the threshold becomes harder to overcome. So all the more reason why you want to have a comprehensive individual policy with that stronger wording and features. And then if they give you a group policy, have it layer behind. The other most important feature within a disability insurance policy is what, in generic terms, I would call the balloon option. This is the ability to increase your coverage amount at a later date without having to answer any medical questions based upon whatever your health is today. So everybody on this webinar knows what their health is today. Nobody on this webinar can tell me what their health is going to be in 2, 4, 6, 8, 10 years from now. So if you're in favorable health now and the insurance company offers you this balloon option, you're putting them on the hook to give you additional coverage at a later date based upon whatever your health is today, not whatever your health is in the future. Now, there's different ways that the insurance companies go about this. There's a way that I like, and then there's a way that I don't like. And that's me being very diplomatic. The good way is every year around your policy anniversary date, the insurance company is going to give you the ability to increase your coverage. And if you don't want to do it, that's fine. Not a big deal. You'll still have that ability the following year and all subsequent years up until the age of 55 or 60. There's no mandatory requirements with this. And if you don't want to do it, you just throw that letter in the mail and next year you'll get that letter again. This is the good way. And this is what I recommend for my clients. Now, there's some insurance companies and some insurance policies where they get cute with it and they retain the control of this feature. And they say every 3 years or every 36 months, we're going to send you a letter in the mail or we're going to send you an email. And then you are going to be required to send back all of your financial information and all of your other insurance information. Oh, and by the way, you got 30 or 60 days to get all this information back to us. And if you don't get it back to us, we're going to remove this increase feature from the policy. And if you do get this information back to us, we are going to tell you how much you have to increase your policy by. We're not going to ask you, we're going to tell you. I don't like this because I know how busy I am and I know how busy you are. And if you miss that letter in the mail or that email, you can no longer increase your policy again without having to answer any medical questions. And that's one of the main reasons to getting a policy now, to lock in your health and to put the insurance company on the hook to give you more coverage at a later date without having to answer any medical questions. And there's an epidemic out there with agents that sell policies that have this really restrictive wording in it that do not fully disclose that to the consumer. And then the consumer's the one left holding the bag when they miss that letter in the mail. And then, the time comes when they want to increase and come to find out that they didn't follow the rules and they can't increase on their policy. So there's a good way and there's a not good way. Company financial strength. It is so important to align yourself with a company that has good financials because the financial strength of an insurance company directly correlates to the insurance company's ability to pay future claims. And there's only a handful of companies in the space that sell disability insurance. And I don't want to say they're all good companies, and I don't want to say they all have good policies. But there's only a handful of these companies out there. And then there's different financial ratings agencies out there that they get under the hood of these insurance companies and they say, okay, you guys have a lot of money in your reserves or you guys are a little bit scaled back. So it's so important to align yourself with a company that has good financials. And furthermore, there is absolutely no correlation between the financial strength of an insurance company and the wording within their disability insurance policy. You can have a company with the strongest financial ratings and a policy that is not medical specialty specific own occupation. And when I say this, trust me. The one type of claim that insurance companies are scared to death of is claims that fit into the mental health arena. And the reason why is because oftentimes these types of claims are subjective. And once these types of claims show up, they oftentimes don't leave quickly. So the way that some insurance companies curtail their risk is by limiting these types of claims to 24 months. There's also some companies and policies where you have the ability to get a full benefit period or coverage for mental health claims that lasts until the age of 65, 67, or 70. And then there's some occupations where they are simply capped at 24 months for everybody. But it's important to know how long these types of claims are covered because it is a really important feature within a policy. Medical underwriting. When you go to get a policy, the insurance companies, they want to know about you because they're putting themselves on the hook for a tremendous amount of money, potentially, and they know that you're going to have this policy for 20 or 30, maybe 40 years. So they want to know about your current health. They want to know if you've had any surgeries. They want to know about your family history. They want to know if you have any pre-existing medical or psychological conditions. They want to know what is in the pharmacy database. And I always take a pause and explain this. Please, whatever you do not self-prescribe yourself meds. Now, there's certain meds that we can overcome. Like if you prescribe yourself an antibiotic or you're leaving the country and you want to have some type of medicine in case you get sick when you're abroad for a few days or a week, we can get over that. But too many times I see when physicians self-prescribe themselves either off-label meds or mental health medicines. And it is really, really, really hard to overcome that. So please, whatever you do not self-prescribe yourself. Many insurance companies, they do not require blood and urine. It's simply a 20 or 30-minute telephone interview, and then if they deem it necessary, they'll request whatever medical records are out there and they'll do a pharmacy database check. So these insurance companies have made it really, really, really easy to secure policies. And if anybody wants to discuss a pre-existing medical condition that they have confidentially, feel free to reach out to me and I can let you know what my thoughts are, whether you can get a policy or can't get a policy, or how the insurance company may posture based upon whatever your pre-existing condition is. So reach out to me, send me an email, call me, go to my my online questionnaire at www.pgy1.com and complete that questionnaire. I'll say that again, www.pgy1.com, and we can then block out some time to discuss your situation. And even if you want to discuss your situation and you don't have a pre-existing condition, I'm happy to do so. But if you do, or if you don't, that's the best way to convey your information to me, and then we can set up a time to talk. And like I said just a few minutes ago, these policies for residents and fellows, you're not going to go broke buying them. You can oftentimes get your foot in the door for $80 or $100 or $120 a month. And by doing that, you're putting them on the hook to give you additional coverage at a later date without having to answer any medical questions. And while we're on the lines of medical questions, from time to time, I will come across policies where they do not require any medical questions. And there are some scenarios where this makes sense, and there are some scenarios where it absolutely does not make sense. So if you are in good health, or you have some nominal or minimal health items in your file, you probably do not want to get one of these no medical questions asked policies. Now, if you have a serious or substantial pre-existing medical condition that would limit your ability to get a robust policy, or it would leave you with increased pricing or certain exclusions on your policy, that is when it would make sense to see if there are any no medical questions asked policies at your institution. Now, these types of opportunities are few and far between. I would go out on a limb and say maybe 1 in 10 institutions or 2 in 10 institutions have these types of programs for residents and fellows. And I have access to these in certain places, so feel free to reach out to me if you think this would be a good option. And if I don't have it, I may know about somebody that does. Like this morning, I had a young lady where I thought it would be good for her to get this type of policy, and I knew that this was an option at her particular institution. So I told her where to go to get a policy. And it's going to really benefit her because I would have been able to get her something, but it would not have been very favorable. I just added this slide to my webinar a few weeks ago, and I think it's so important to let you know about coronavirus and the possible impacts it could have on disability insurance and life insurance in the future. So we are all in uncharted waters with the coronavirus. The insurance companies, they have no data actuarially about how many people can and will go on disability claim due to coronavirus. They also have no data on what the lasting effects of the coronavirus are on one's body or on one's lungs. Now, it's many, many years after SARS, and there is data out now that says how much of an impact SARS had on the pulmonary functions for those of you or for whomever had SARS. So I think it's so important for people to lock in a small policy now. And in doing so, you're going to put the insurance company on the hook to give you more coverage at a later date without having to answer any medical questions. Because these insurance companies, once they have a little bit more of a track record on coronavirus, they could potentially change the pricing, they could potentially change the wording, they may underwrite the policies differently, they may ask different medical questions. We don't know any of this, but we do know where we are now. And if you get a policy and you lock everything in now, you are going to put the insurance company on the hook for later, and these factors aren't going to play into your policy. Insurance is regulated on a state by state basis, and there's 4 states that are a little bit different than the others. So these states are going to be Florida, California, Arizona, and Nevada. So if you know that you're moving to one of these states, but you're not there just yet, you're going to want to get the process started before you go there to secure a policy, and then you are going to lock in the wording and the features of the state that you started the process in rather than the state that you are moving to. And I don't know about you, but I don't want to pay extra on a policy for the next 20 or 30 years, or I don't want to have certain wording scale backs on a policy for the next 20 or 30 or 40 years if I don't need to. And on the flip side, if you're currently in Florida, California, Arizona, or Nevada, and you know you're leaving, I think it would make sense to do your homework and figure out, okay, well, if I were to get a policy now, what would it look like? Or if I were to wait a month or two and get a policy in my quote unquote new state, what would it look like? And I never want anybody to wait, but I want you to understand the differences and then make an educated decision whether it makes sense to wait or whether to get it going now. And if you're currently in one of these states and you're staying in one of these states, well, you just got to do it and get yourself a policy, and maybe you'll pay a few extra bucks, but it'll be okay. You'll make it. I just don't want you to overpay if you don't have to. Financial underwriting. It is extremely easy for graduating medical students, residents, and fellows to get disability insurance coverage. They're not going to request any tax returns. They're not going to request any pay stubs simply because you are a student, resident, or fellow. You can get a certain amount of coverage based upon where you are in your travels. And most residents and fellows can get $5,000 a month. If you're on the back end of your training, we may be able to use your employment contract to get you significantly higher amounts. Some of the additional policy features that people do consider are going to be what they call the residual or the partial rider. The vast majority of disability claims either start or end as a partial claim. And it's really important to have this type of feature on the policy. Now, with that said, just because a company says that they have a particular feature does not mean that it is a robust feature. Once again, if I were to show you 5 different policies from 5 different companies that all claim to have the quote unquote same features, all of these features are different and specific to that particular policy, with that particular company. There are really good versions of this residual or partial rider, and there are extremely poor versions of this. So just because they say they have it does not mean it's good. Some companies allow you to pay what they call graded premiums. Think of this as rather than paying $1 for a policy, the insurance companies say that you can pay 50 cents for this policy. And then when you're an attending physician and when your cash flow is a little bit better, you'll have the ability to change it over to whatever that dollar premium would be at that point in time. So the whole, or one of the main reasons to lock in a policy early on is to lock in your health and lock in the ability to do a policy increase later. And if you choose to pay the partial premium or the graded premium, that's fine, as long as you know that when you start out as an attending, you're probably going to want to switch it over to the fixed premium, or the level premium as they call it. And this is really important because you really just want to get your foot in the door initially. How you pay for it, if God forbid you need to collect on the policy, it doesn't matter. The cost of living adjustment, or COLA. Think of this as inflation protection. If God forbid you go on a disability claim that lasts for more than a year, oftentimes that will be when the inflation component kicks in on a policy. Now, not everybody gets this feature, but on an individual basis, I go through this and I talk about the pros and the cons, and we decide if it makes sense for you or not. And you can always get rid of features from a policy, but it's hard or impossible to add them if they weren't included from the start. And another feature that once in a great while people get is student loan protection on the policy. Now, the reason I say that is because if you have government student loans and something happens to you and you become disabled and aren't working, well, if you have government student loans and you're on an income-driven option for the student loan payment, if you have zero income, you're going to have zero payment on your loans. Furthermore, many of these private refinance companies and even the government, there are provisions where if you are permanently or irrecoverably disabled, your student loans would be waived or forgiven. So once in a while, this makes sense, but not too often. And there's other features too, but these are the main ones that people typically choose from. Reasons to secure a policy while you are in training. Financially, it's easy to get a policy. They're not going to require tax returns. They're not going to require pay stubs. It's just easy based upon wherever you are in your travels. You can get a policy that covers you for X amount. Many insurance companies, they don't require medical exams. It's like I said before, it's just a maybe 20 or 30-minute telephone interview where they're going to ask you the health questions. And oftentimes that's enough to get you approved for a policy. The balloon option, which I've spoke a tremendous amount in this webinar. You want to get a policy as early as you possibly can, because if you're in good health and they offer you this balloon option, you're putting them on the hook to give you more coverage at a later date without having to answer any medical questions based upon whatever your health is now. And the last reason is discounts. Now, I never sell policies based on price, because there is a direct correlation between policy pricing and policy wording. However, if you can get yourself a really robust policy that has a discount, it is terrific. But just don't price shop for these policies. I can show you a policy that costs 60, another one that costs 80, and another one that would cost 100. And when you figure out what the $60 policy and what the $80 policy are lacking in, chances are you're going to buy the policy that costs 100. Because the pricing discounts are so nominal in the grand scheme of things, it's so important to lock in a really robust policy, even if it costs a little bit more money. And in life, you get what you pay for. Hopefully, you never need these disability insurance policies. But the last thing you want to do is price shop for a policy and end up with a policy that doesn't have the right wording or doesn't have the right features because you tried to save yourself $11 a month when you're making $300,000 or $400,000 a year. Don't be penny wise and pound foolish. Red flags associated with disability insurance. There are some insurance professionals out there that map out 5 different disability insurance policies on one page. And I've been doing this stuff for 20 years. I cannot figure out how these people can map out 5 different policies on one page. It baffles my mind. It takes an insurance company 50 pages to map out one policy, and these agents can somehow map out 5 policies on one page grids. It is amazing to me. These grids are littered with misleading or oftentimes incorrect information. So if you see one of these grids, run far and run fast. Another red flag is going to be insurance professionals that only represent one insurance company. Like I said when we started this webinar, I am independent. I represent multiple companies. There are some types of agents, they are called captive agents, and they only represent one company, and it is their job to sell policies for that one specific company, whether it be in the best interest of the client or not. If the cost of a disability insurance policy seems too good to be true, it likely is. And once again, do not price shop for these policies. These stronger policies are naturally going to cost more. And that brings me back to this grid, that one-page grid again. When I see these grids, they map out 5 different policies, and then at the bottom, and they say, this is the price for company A, this is the price for company B, and this is the price for company C. Buy company C because it's the lowest price. Well, if it was properly explained to you what the policy differences are between A, B, and C, you're not going to buy the one with the lowest price. For that small price difference, you're going to buy the policy that has the most robust wording. And these one-page grids do not map out the wording. They treat these policies as if they are a commodity and they are all the same, which could not be anything farther from the truth. Where and how to apply for disability insurance. Like I said so many times, I'm an independent broker for insurance. I represent different companies. If you want to begin the process to securing a comprehensive individual policy, feel free to scan this QR code with your telephone, and this will bring you to a secure online portal that I have that can have you answer the vast majority of the questions that are required to submit an insurance application. And this will show up to me via secure email, and then in the next few days or in the next week or two, we can block out some time to talk. Furthermore, if you do this QR code or you go to my secure online portal via this URL, I would also ask that you go to www.pgy1.com and complete my questionnaire. This is going to give me a global understanding of your situation, and this is what allows me to make policy recommendations for you because I want to know everything about you. I want to know what you're doing for work, if you're going for public service loan forgiveness, if you're going to have group disability insurance or not, if you're on any medicines, if you have student loans, if you're married to another physician. I customize every disability insurance policy for every client because you really get one shot to get this thing done right. So you better do it right the first time. And like I said, if anyone has any pre-existing medical conditions or they want to bounce something off of me, feel free to reach out to me and we can discuss that confidentially. Life insurance. In addition to disability insurance, I am an independent broker for life insurance. I represent more than 20 companies for life insurance. And the time you're going to want to really look at life insurance is if you're married, if you have dependents, if you have co-signers on loans. There's wanting disability insurance and there's needing disability insurance. If you can answer yes to one of these 3 things, you need life insurance. Now, you may not need life insurance. You may want life insurance, and there's absolutely nothing wrong with that. We can get policies for everybody. There's different types of policies out there. There's what they call term life insurance, where you're buying it for a specified term or you're buying it for a specified period of time. This is going to be the most cost-effective way to purchase a lot of insurance for not a lot of money. And you can get these different terms. You can get a 10-year, a 15, a 20, a 25, or a 30-year term policy. And if you're a 30-year-old resident and maybe you have a spouse or maybe you have a dependent or two, and your cash flow is a little bit tight, term insurance is going to be the way to go, because this is going to be the lowest cost way to get the most amount of life insurance when you need it the most. And I represent a tremendous amount of companies that offer good term life insurance. Then there's other types of policies that are called permanent life insurance policies. And these are whole life policies, variable policies, universal policies, and indexed policies. I don't want to say these are good. I don't want to say these are bad. I will say there's a time and a place for these policies. And if you're a 30-year-old resident with 2 dependents and a restricted cash flow, you don't want to get a permanent life insurance policy. You want to get the right amount of term life insurance. And these term life policies do not cost a lot of money. I'm just going to throw out some rough numbers for you. If you're 30 years old and you get $1 million of 20-year term life insurance, maybe it costs you, I don't know, $300, $400 a year for $1 million of 20-year term life insurance. If you're 30 years old and you lock in $1 million of 30-year term life insurance, maybe it's $600, $700, $800 per year. And the cost is linear, so if you want $2 million, just multiply it by 2. But this is absolutely the most cost-effective way to get a good amount of insurance for not a lot of money. And if you're on a restricted cash flow, this is what you should get as a resident or a fellow or potentially even a new attending. Furthermore, not all life insurance policies are created equally, and term for that matter. So we want to know the company financial strength, because once again, the company financial strength, that dictates, or there's a relationship with the abilities for that company to pay a claim. So strong company financials. The most important feature within a term life insurance policy is what they call conversion. This is the ability to extend your coverage amount at a later date based upon whatever your health was when you got the initial policy. So let's just say you're 30 years old and you get yourself a 20-year term life insurance policy. And then fast forward, let's say you're 48 years old now, and God forbid you had a change in health. And you know that you only have a couple years left on this policy. And then the policy is going to go away. So if you have a policy that has a good conversion option, you can actually change the type of policy that it is within that specific insurance company based upon whatever your health was when you were 30 years old. So you were really healthy non-smoker when you were 30. Now, when you're 48 years old and you have some track record now with your health, you can actually convert that policy to like a universal life policy or a whole life policy. Now you're going to pay as if you were a 48-year-old. However, it's going to be whatever your health was based upon whatever age you were when you got the initial policy. So you'll be able to pay for that whole life or that universal life policy as a very healthy 48-year-old, as opposed to a 48-year-old that just had a major blip in their health and cannot get new insurance or cannot get new life insurance at a reasonable cost. And I take into consideration the cost of a term life insurance policy. However, these policies all cost relatively the same. I'm not worried about the difference of $10 or $20 or $30 a year if it means one policy has a good conversion option and the other policy doesn't. I'd rather see you pay a few bucks more and have that good conversion option. I want to thank everybody for logging on to this evening's webinar, and I'm going to open it up for questions. Feel free to type in your questions on the control panel, and I'm going to hang for a few minutes and let everybody type in their questions. And then I'm going to stop recording now, and then I'm going to answer all the questions that come through. So feel free, if you want to discuss your situation on an individual basis, to go to www.pgy1 and complete my questionnaire, and then we can block out some time to talk. You can also call me or email me, but the easiest way is to complete that questionnaire, and then we can block out some time to talk. And feel free to share this when I distribute it with others in your program or other friends or colleagues that you may have that can benefit from the content. Hopefully you picked up some good information this evening, and I want to thank you for logging on and thank you for doing what you do, and feel free to reach out.